Welcome to Vantage Point Podcast, a podcast brought to you by NWR Communications and 92 Studio. This podcast is intended for education and entertainment purposes only and does not constitute financial advice. G'day and welcome to the latest episode of Vantage Point, where we're joined by Unified Capital Partners co-CEO and Head of Research, Jonathon Higgins. On the episode, he covers off his journey to becoming an analyst, the formation of Unified Capital Partners itself, as well as a couple of key picks and a preview of the upcoming reporting season.
Jonathon Higgins, Unified Capital. Thanks very much for joining us. We go way back, but for those who are tuning in and listening and watching, talk to us about how you became an analyst, and we'll get to Unified Capital, but just your professional background first would be great.
Appreciate the opportunity to come on the podcast today, Simon.
Pleasure.
And also to the entirety of the NWR team. Look, I mean, my background was originally that I did a technical degree to start. So I did a science degree majoring in civil systems at Melbourne University, which probably isn't your typical path into equities research. But always had a sort of a healthy sort of respect to financial markets. Started trading very early on personally. And also some family sort of connections into parts of the investment community and the like. So finished up that degree, moved into a Masters of Commerce majoring in finance, and then alongside my sort of like my university career, I was also in debt collection of all the places to be. So
Can't imagine you rocking up at the door with with a hammer.
Yeah, probably not so much on the physical side of things, but in terms of talking them off the ledge, maybe there's a little bit of that sort of thing going on. So I ran a team of debt collectors, had some experience in that, and was doing that sort of, with some reasonable hours through university. And I think that sort of provides a little bit of background also towards some of the communication
Talking
skills.
the talk, yeah.
Yeah, exactly. And also, like, you sort of take that and if you can sort of convince somebody to sort of clean up some of their debts and the like, potentially you could sort of also talk to them about stocks.
Positively investing as opposed to being in a hole.
Yeah.
And talk to us about Unified. Obviously, it's probably been 18 months or 2 years since it's been around?
Yeah, it's coming up on, I think, just over 18 months towards the 2-year mark. So we started Unified as a collection of partners. So I've got several other individuals in my business. I've got Jared Davis, who sits in the co-CEO role with myself, Tony Davis, who's obviously pretty well known in investment markets, Mark Gray, and then we've got several other sort of individuals. I think we've grown to 16. We started with 12, and the whole idea around Unified was, as the name suggests, take a unified approach to the research, the sales, the corporate, the M&A, and the advice angle, and sort of really take a narrow approach in that we find. Like a series of sort of structurally growing businesses, look to connect up parts of the buy side and the fund manager community. And look, I think at the end of the day, if one wins, we all win. And so although, we're obviously highly compliant and all those types of things, we do like to specialise and sort of hunt like a pack in terms of in the broking side of things. So, so it's going 2 years in, it's going reasonably well. I think markets have been pretty positive in that period of time too, but it's been, I think, a little bit better than what we expected when we started the business.
Yeah, I think that's probably an understatement in terms of the success of the amount of raisings and block trades and sell downs and different things. So it's a credit to you guys for having the guts and going out alone. But just to actually why make the move and the risk, I suppose it's a pretty big move to, previously at Shaw and Partners, Bell Potter before that, sort of bigger sort of, retail institutions and whatnot. It can all go pear-shaped.
Yeah, and to be frank, there was those thoughts were crossing my mind personally and also professionally when we were going about thinking about doing Unified. And look, I think broking's a sector that has consolidated materially over a long period of time. The number of broking firms in the market over a 20-year period has probably, I think, decreased by 70 or 80%. And when we were starting up, I think there was other well-known firms such as CCZ, for example, which were closing down. So, it wasn't a great environment in terms of that. But I think we've come to the end of that glide path, would be my comment. I think that, broking, and particularly high-conviction institutional broking, has contracted to the point where I think it grows from here. And I think some of the balance of power is starting to sort of turn the other way. But in terms of risk, there's obviously risk around capital. We trade big numbers every day. We underwrite transactions. We have reputational risks. We have advice risks, all these types of things. So, I think in a small firm, it can be managed. The bigger you get, the harder it gets. For Shaw and Partners and Bell Potter, they were two great firms. Had a great time at both of those firms, and they very much allowed us to, sort of grow our business internally inside of those businesses and sort of have nothing but good things to say about those two firms and and the principles and such there. But intrinsically, I think broking and a lot of financial management's a people business, and we just felt we wanted to do it ourselves, and that was the reason why we started up Unify.
And there's a fair bit more leverage when it's just 16 of you as opposed to 1,600 heads sort of thing. So it's done well. And sort of stepping back in terms of an analyst and whatnot. What are the sort of key things that you look for in companies? Obviously, the fees and capital raisings and all those sort of things pay the bills, so there's that sort of overlay. But in terms of companies, what's your sort of view of the world when you look at a company and why to pick it up and whatnot?
Yeah, I think it depends what part of the market firstly you play in. Like we play in a part of the market where we specialise in companies that have probably got a market cap of sort of 200 million up to 800 million, and then as they grow, hopefully you sort of hang on with your engagement and some of those corporate activities like what you spoke about. What we look for at its very core is we look for management teams that can deliver on what they say they're going to do. And then we look to put a series of macro and micro sort of points of analysis around that, because I think that any management team that delivers on what they say they can do, the value of the company is going to be higher over time. The magnitude of the value might be different, but if you can sit across the table from a CEO and a CFO, and we're very spoiled in getting access to some really good managers around that. If you think they can deliver what they say they're going to do, and maybe be that a 3-5 year business plan, a certain set of earnings, market penetration, whatever it may be, then that's a good company and that's worthwhile looking at. In that context, you then need to overlay: can you make a difference on the research front? Is it undercovered?
Crowded,
is it overcovered? Yeah, and I think that certain companies have that issue. When you've got 15 analysts on a business, it can be very hard to make a difference. I think what we're known for is being number 1 or 2 in every company that we cover in terms of insights and analysis, and also on the structural side of things, we like picking up companies that are good set of structural tailwinds. So, like a lot of people ask me, how do we find our companies? Because we've had some pretty reasonable companies, and we've had some companies that haven't gone so well as well. But the secret sauce is looking at a lot of different companies constantly, and some of these companies might enter the gate for being something that you want to cover at certain times, and it might not be now. It might be something that you think about covering in a year or 2 years' time, and you just have to invest the time and the effort. And there's plenty of companies on the ASX to look at.
No, exactly. And in terms of you sort of spoke to companies, but how you sort of look at the broader market and relationships, it's a bit of a weird one with regards to if you've got a corporate client or you cover a company and you raise for them or whatever. Obviously you're not doing that, but the other guys at Unified. How do you sort of marry up and you've got the corporate client being an ABC company, you've got the fund manager who's a client day to day, and then you've got your sort of retail high net worth clients. How do you juggle that?
Well, look, it's actually the $1 million question when it comes to broking, and just I think a lot of these industries in general. I think if you look at a fund manager, they've got one client at the end of the day, which is making unit holders money. Look, on the research side of things, we just look to completely act independent. We look to provide independent analysis on those businesses. But from a firm point of view, I think all of company management, company shareholders, fund managers, and the sell side, when it works really well, they're all aligned. And this is also the same for IR. I think when everyone's working together, and you're looking at a business which can, deliver across everything it says it's going to do and deliver with stakeholders, including brokers and fund managers, then you do get a really good result. So I think at times it can be in conflict, but in a perfect world, you're looking for companies where they can all be the same.
Everyone wins.
Yeah, I think, exactly. I think everyone does win, and everyone can win in some of these relationships. What we do find is that absolutely the best thing that companies can get is, some great shareholders, great IR that's, talking towards the companies and telling them how to present themselves. Maybe they're opening up a different set of investors or a different way to think about the business. And you've got great sell-side analysis. And, if that's all working in concert, which it doesn't always do, then, you can get a very powerful outcome in investment markets. And I've seen it happen many times. And when it doesn't work, it's also something not to be too worried about.
Yeah.
There's plenty of companies and plenty of opportunities.
And just dovetailing in terms of the focus around Unified, is sort of, had a look at your company cares or your sort of coverage list earlier this morning. There's a fair few there. What do you sort of see as, particularly at the moment, things will be hot. Buy now, pay later was hot a few years ago, and then it ripped back again last year.
Yes.
And things go the other side. We're obviously February 7th, about to hit peak reporting season. What are the sort of key themes and key things that you're looking for heading into reporting season?
Yeah, it's a good question. Look, I think you've always got to try to take an early read on reporting season in the near term. I obviously cover the buy now, pay later complex, which has been popularised by Zip in the last 12 months, which was up 1,000%, and I think calendar year to date's down about 30%. So, one of the short-term learnings probably looking at is, just the crowded trades and expectations. I think, Zip became a heavily owned stock. I think expectations for the business ran far ahead, and it's seen a significant derating in the share price, losing over $1 billion in value early in this reporting season. And so, I think if you take a step back from that company, it's, it represents exceptional value, and there's some good things to come in that business. But one of the early reads, I think, is that there's a lot of fund managers out there. There's a lot of people doing work on similar companies. And so I think it's important to have some unique ideas. Look, I think more medium term, long term, there's been very little breadth in investment markets. So, as breadth improves, that's good for the entirety of the industrials universe in microcaps and small caps, a sector that you and I both sort of look at and focus on. So we should feel positive about that as breadth improves, because, part of the reason we're getting these concentrated trades is because everyone's concentrating in the same name, because there hasn't been a huge amount of liquidity. So I think that's a thematic for this year, as well as some of the sectors we like. We like alt fires. We like electrification candidates. We like some of the lower valued companies like Aviva Leisure, for example. And we also like a lot of the mining services complex. I think there's some significant work to come in the second half that we're looking to benefit from.
And probably going back, and I imagine Zip is one of the successes. Can you sort of just talk about, you can, with all due respect, you can get lucky in terms of picking up the right sector, or tides rise all boats, whatever the saying is. What's your sort of best success, both from a stock picking perspective, but also as a firm? It doesn't have to be unified as well, but getting behind something early and actually fostering, holding on to that relationship sort of thing?
Well, I think it's probably at a macro level, it's about identifying a structural trend. As you said, buy now, pay later is probably the best I'm known for at the moment. Yeah, I've been covering that sector for 7 or 8 years. Worked under a really good analyst also at Bell Potter, a gentleman by the name of Lafitani, who also did well out of that sector. And I think that if you look at buy now, pay later, it was something that made a lot of sense. You could get credit in 2 minutes at the checkout rather than taking 2 weeks. And so, as a young analyst, I sort of thought that sounds pretty good. And so I got a little bit lucky on that. That's turned into a global sort of structural trend, that one. I think, other trends I've looked at is like, cloud was obviously an early one. I was very lucky to cover, a company called Ripe and look at some of the key cloud peers really early on. This is when Microsoft was starting to talk about Azure for the first time, starting to talk about structural trends in cloud, and to dumb it down at the same point in time, I was sitting there going, well, why would you host your own capital and data center on your own floor in expensive space and not be very good at it when you could host it in a Microsoft or an Amazon data center, at a fraction of the cost with better computing power and the like, and turn it into an OPEX line. So, I recall writing about what public cloud actually was 6 or 7 years ago, and, that's turned into obviously a very strong trend, which is now being AI. So I think at a macro level, it's effectively about, if you can identify structural trends, if you happen to get one every now and again, then you can have multi-years of tailwinds behind it. And it's not easy to get those trends. Seeing things like AI and cloud and alt-fi and stuff are all things that, are once in a decade or 2 decade like opportunities. Been lucky enough to do that, and been lucky enough to have some good management teams of companies that have been in those sectors. I think the one at the moment that's really interesting is electrification. Obviously topical in the context of Donald Trump, sort of pulling out of the Paris Agreement. I think it's a trend, though, that's only going to gain momentum downhill. The level of investment required to electrify the economy for electric vehicles, for data centers, for all these types of things, I think is something that's going to be huge. There's very little leverage on the ASX for companies that are in the data center space, and I think electrification probably provides that trend. So that's probably the one we're looking at the most at the moment. Outside of that, I think, from a macro sense, the Australian economy is under severe pressure at the moment if you exclude the public service. And so, there's been no earnings growth in the ASX 200 for reference for the last 3 years. We've had a per capita recession decline, I think, for 6 or 8 quarters in a row. So we really need to see things start to loosen up to see some of the other sort of more micro trends come back in Australia, in my view.
And flipping to the other side in terms of the things that we don't usually like to talk about, but we're all human, and you learn from the big blow-ups. What's sort of, whether it was early in your career or, I suppose stepping back again, do you learn more from the successes or the failures of coverage, etc.?
Yeah, it's definitely the failures. Yeah. And there's I've had, a particular company called Access Today is probably the best example, which was operating in the leasing space, in the finance space, and that company effectively, I think, went from about $2 a share, multi-hundred millions in market cap, down to being delisted and going bankrupt within, I think, about 10 days.
That's very quick.
I spent probably 6 months, in a cold sweat thinking about it. Obviously, investors lost money in that business, whether they're high net worths or fund managers and the like. And look, there were several learnings to come out of that. It's important to sit down and think about what they are. There were red flags in that business, red flags in the operations, and that played itself out invariably in a bad outcome for shareholders. There was also a lot of leverage. You've got to be very careful of leverage and the downside in that. So, that's probably the most specific example, but in general, you really do only learn the lessons from the losses. And there's a fund manager in particular that provided probably a lot of comfort to me more generally when that Access Today event occurred, and said that it was probably one of the best things that's going to ever happen to me.
Yeah, exactly.
It didn't feel like that at the time, but it's allowed me to view companies like that in a different lens. And I valued that advice at the time and still value that advice today. I won't mention him on the podcast, but I think there's several investment managers also that have said similar things to me where they've learned lessons through a Slater and Gordon, or whether it be an Access Today or a Babcock and Brown, some of the companies you might not know much about at the moment. But usually there's a mix of events, which is people, management teams taking overt amounts of risk with leverage, and you can usually see it coming.
I think that's one of the perils of operating in the space that we play in. I've certainly been involved in my fair share as well, which is, again, very easy in hindsight. And sort of getting away from the bad stuff, to sort of culture and, you're managing director, co-CEO at Unified, more operationally speaking, how do you sort of look at, I know we spoke yesterday or the day before about, trying to get into the gym together as a team and that sort of thing. How do you sort of look at culture, and Unified is in the name, but how do you sort of look at that going forward and working as a team?
Look, it's a great question. I think financial services culturally can be a really tough industry to be in. It doesn't matter what side of the spectrum it is. There's big personalities. You need the ability to bounce back from hard days, long hours, all sorts of things, conflicts like what you mentioned. Look, I think the important thing for us is that we have a team that's had a lot of duration together. I think that it's very rare that team members leave our business for whatever that reason may be. And as a result, we know exactly what our roles are in the organisation, and we look to then execute on those roles, whether it be high conviction research or really high conviction sales off our Sydney sales desk, or our corporate guys that sort of clue in with both of those things and provide a good outcome for the corporate clients. So, at its core, I think it's a lot easier being small. Managing being in a business with 16 people, we're all on first name terms in the same WhatsApp group, sort of talking towards together, I think is really, really quite an easy thing to do. I'm not sure whether we'd be able to replicate it on such a large scale. So I think, it's about getting the right team members in at the start. It's then about incentivizing them and knowing how that they operate through to the end of the year. And I think we all agree that one thing that we have as a firm and where it comes from is that everyone in the organisation gets a vote via division. And so you don't get one division disagreeing with another division. And as a result, if that occurs, you're more likely, I think, to get a better outcome. So I think, professional feeds into cultural. I think we all enjoy getting along with each other. We regularly go out and have a beer or have some lunch together. And also, as I said, there's a lot of chatting away every day on everything that's happening in markets and also personally.
That's the way that it should be. And probably another left of centre call. I know that you've been approached and you're well and truly bedded down as on sell side now, but buy side versus sell side. You've been tempted in the past or approached in the past. I'm assuming you're happy that you stayed sell side. How do you sort of look at that? Because it is a sort of aspirational, competing, winning, in terms of investing in markets and whatnot. Not that you can't do that personally, but how do you sort of look at that?
Oh, look, it's a great question. I think, I have a lot of respect for my buy-side clients and compatriots. I mean, although some of them might have taken a similar journey to what I've done, they have intrinsically a very high-pressure job operating, real capital rather than cared capital on the sell side, I'd say. And I think they also have a very competitive job. I think if I was to sort of think out loud, there's probably 15 sell-side firms of reasonable size in Australia. If the average team size is 10 to 15, there's a few hundred people that are on the sell side in general doing what we do. I think if I look at the buy side, there's hundreds of clients on the
crazy.
buy side. The average team size might only be 4 or 5, but I think they've got their own pressures in terms of fee compression, obviously managing FUM, and alpha's really hard to do. So I'd say from a high level, like the sell side to me feels like a place where there can be some structural tailwinds. I think the buy side, has got tailwinds, but it's very hard from period to period. So look, I'm very happy on the sell side. Never say never about the buy side, but obviously as a principal at Unified, fully invested in this business, want to continue
100%.
to do it. And look, realistically, I think that my skill set really does queue with the sell side. I like to think I can pick good businesses, but I think some of these buy side fund managers are probably better at picking, the 20 to 30 to 40 that make up a portfolio more wholesomely than what my ability currently sits at, would be my comment.
It's definitely a different task from covering just one or picking just one winner, but it's a perfect segue, and obviously not financial advice, but going into reporting season and the next time you come back on this podcast, which hopefully won't be too long, leave us with one pick and why.
Look, I think probably probably the pick that I'd be most excited about is a company that's operating in the energy management space, Energy One. This is a company which people don't particularly know too much about.
Ticker's EOL?
Ticker, ASX EOL operates here in the domestic market. They've got about 50% market share of all energy trading activities in Australia. You should think of them as being the Iris or Bloomberg of energy trading and software management in Australia, and they've got about 20% market share into Europe and the UK, so they operate out of France, Belgium and the UK. Look, they're a business that's got software-like margins, got 20 to 25% EBITDA margins. It's growing at over 20% per annum. They've had a takeover bid in the last sort of 12 months, which they sort of knocked back at about $6 a share. And it's got market-leading operations in Australia, so AGL is one of their big clients, and they're obviously getting a lot of growth out of the electrification thematic, which I spoke about. So, look, I think on a multi-year view, they can grow from a $60 million revenue business up to a $100 million revenue business and be, sort of 3 times higher on a 3 to 4 year view. I think, that's probably one of the more exciting businesses. Look, I know you said only one business, but I'll give you another one.
I'm happy with a shorter term as well, rather than 3 to 4 years.
Well, I think like a joint client, of both of ours is probably worth mentioning as well in the context of this podcast. I did speak earlier around, sort of the leverage in towards crowded names and some of the higher valuations. I think that's a very dangerous thematic. And what we've seen calendar year to date is tech's materially underperforming, and some of the lower price cyclical and industrial names are starting to come through. And Viva Leisure, VVA, is a company that I cover. Sorry, that James Biznella at my firm covers.
Don't steal his coverage.
Yeah. Apologies for the misstep there.
I like that.
So James covers, and also obviously NWR.
With Harry and Kim and the team.
That is one of the cheapest businesses on the ASX. It's about 1/5 of the multiple of where global peers sit. It's I think a top 12 or top 15 gym operator in the world. They've got a host of various sort of dynamics around, their software systems, their entry passes, payments, and they have a very entrepreneurial management team. They are very conservatively priced. I think they're continuing to deliver to expectations. They're growing 20% organically per annum. And the reason why I mention it here is, this is the sort of stock where it's just going to break out at some point. It's been relatively flat. They're buying back stock. Management's been delivering the guidance. And, these are the uncovered gems that I think over time, eventually you'll wake up and they'll re-rate materially. And it'll come as the free cash flows come. And we're starting to see that out of the business, which is really positive.
One to definitely watch, and appreciate the kudos as well. But thanks so much for joining us, Jono, and looking forward to having you back on soon. Good luck for reporting season.
Thanks for having me, Simon.
Cheers.